Gold looks like it's about to meaningfully break out to all-time highs. Long bond yields are going higher, US equities lower, dollar lower. It does seem like some fundamental rotations going on.
I think everyone starts thinking about how they're going to want to be positioned to the end of the year, starting in September. I don't think now's the time to really take like home run risk, but set yourself up for having some good swings later in September when things change.
This episode is brought to you by VanEck Semiconductor ETFs. You'll hear more about the VanEck Semiconductor ETF, ticker SMH, the largest semiconductor ETF, and its newer VanEck Fabless Semiconductor ETF, ticker SMHX, later in the show. The Blockworks Digital Asset Summit, crypto's premier institutional event, is back in London this October 13th to 15th. You've got top speakers from BlackRock, Circle, Coinbase, the UK Parliament, and Athena, all under one roof. I'll be there as well, hosting a live forward guidance episode with Quinn and a few others. So if you want to see us record in the flesh or meet some of the other legends from the forward guidance community, this is your shot. Notable macro names like Michael Howell of Cross Border Capital and Jeff Park are already confirmed, with more coming. There's also a VIP dinner on the 13th that will sell out fast. That's for speakers and VIP ticket holders only. It's at Old Billingsgate in London. Use code FORWARD100 for £100 off. See you there. Nothing said on forward guidance is a recommendation to buy or sell any investments or products. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice, or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions in the company's funds or projects discussed. All right, what's going on, everybody? Welcome back to another Roundup edition of Forward Guidance. This week back, actually, I don't know if we've ever done a duo of you and I, but Quinn's away. He's on a flight right now. Not sure where, but can't make it this week. So taking everybody into the long weekend, just me and Tyler. What's up, man?
What's up, dude? It's unfortunate Quinn's not here. He's usually my punching bag. He's easy to roast.
He'd be taking laughs today with the market action going on. So
yeah,
maybe that can keep him humble and into the trade for a bit longer now that he can miss, victory lapping it.
Exactly. So victory lapping it for about, I don't know, a couple hours, but
we'll see. Yeah.
We'll see how long it lasts.
We were saying before we started recording, but I always, we're recording on the Friday into long Labor Day weekend, long weekend. And to me, it always represents an interesting pivot moment just to think about the year so far and what comes next. Like typically into the summer, you get the low vol regime and it feels like whatever's happening just sort of continues. And we've just seen that grind up in equities for a couple months now. And, vol is, I don't even know where the VIX is, but probably pretty low, maybe at least before this pop. But yeah, it's like sort of this reset point, I feel like. And oftentimes, September, October can be pretty volatile. It feels like it's often the time where you do see these pivot points. So I think it's an interesting point to just take a step back and just hear how both of us are thinking about approaching this. Tyler, you got a lot more years of trading under your belt than I do. So I'm curious, how do you think about this time of year going into Labor Day?
It's tough. I mean, the market structure has changed and, I'm going to go really into it really fast, but check out slide 24.
Boom.
Yeah.
Right away.
This is where, back in the day, I think people would adjust their books heading into September way more when it was an actively managed market. Now you get these, low volatility periods. Like August was super low vol, and all the systematic investors are way more powerful now. So that lasted all the way through August. And I think what's happening, it's end of month. You probably have a lot of rebalancing happening today. So you get the VIX pop, you get people selling tech because it's massively outperformed. Now they're rotating into small caps. That's one big theme here that I think's gonna turn up as the cost of capital goes down, and the rotation from large cap tech into small caps. And into September, generally what you're thinking is, okay, a lot of mutual funds have year end in October. They're looking at their tax loss selling. So I think they come back from summer, they get in the office and they're like, okay, what's underperforming in my book? We're going to get ready, early September. I'm going to dump some of the losers, maybe position for, the end of the year, fourth quarter, like low vol rally, I guess you could call it, Santa Claus rally what they call it. So I think everyone starts thinking about how they're going to want to be positioned to the end of the year, or starting in September. So you have that early vol pop. And also there's a lot of, everyone was gone for the summer. And generally you have a little bit of fixed income volatility early in September, because you come in, everyone who didn't issue bonds over the summer is like, you know what, I need to, refinance, or especially where credit spreads are now, supply usually goes up, and there's a little bond vol that leads into equity vol. So that's something to look for here early in September. But I don't know, nothing really scares me macro wise other than that. So that's where I'm at. What about you?
Yeah, I think like the two things to add on to that from the market structure perspective is you're right. Like the dominant flows these days are the passive versus active thing. So you have that like just constant bit of passive, and then you have the CTAs and the vol targeting funds on top of that too. And it just feels like if you just think about especially the vol targeting funds, right? Like we were at friggin' 60 VIX in April. And now we've just seen this steady grind to, now we're at we're at 15 right now. We're at 14 on the open this morning. So just that systematic bid is, as vol comes down, the vol targeting funds will increase their bid sort of, systematically. And then same with CTAs, right? That as we hit these key levels. So it just feels like it, to your point, it's all a flows game. Like that's really it, and I think that's what's so hard. Like you just look at so many of the discretionary macro funds out there that see the fundamental stories, or at least like their perspective on them. But like you're going against these very passive flows, whether it's CTAs, vol targeting funds, or passive flows, and you need a very reflexive and consistent catalyst to fight that, and that's a tough thing to fight against.
You could be right on a stock fundamentally, but yeah, these things that shake you out, they take you to the point of capitulation, and then it reverts really fast. That's the hard part. The interesting thing this time around, like the VIX is up 7% today, but the credit spreads are barely budging. HYG is flat on the day, so this is largely an equity de-risking. And then the 10-year yield is up like 2 basis points, like not much. There's nothing really in fixed income land that's really scary. So it's hard to really, you have to see cross asset now, because a lot of the flows systematically on the equity side of things they're mind boggling. And because the market structure is so thin on the equity side, like 50, I bet you it's even higher now if you looked at the percentage of trading volume. So when I first started trading, this is like 2007, 2008, it was like you could be 30% of the volume of a stock throughout the day, and you wouldn't really move the stock because there was a lot of actively managed money that was like crossing stock against you, et cetera. Now, if you're 5%, and I'm talking like when you're dealing with millions of shares, 5% of the volume, maybe even less. I bet you 3% of the volume can actually have an impact on price now, because 60% of the volume is just fake liquidity. It's high frequency trading. It might even be higher than that now. I gotta dig into that more, but I know it was like 50% at least a couple of years ago. So as the counterparties, and this is partly a centralization problem, it gives you the illusion that there's liquidity, but there's really not. So when the VIX pops and everyone has to sell and the systematic guys rush to sell, there's just gaps in the market. And that's the worrisome part of this market structure, is all of the counterparties have the same incentives. So if you're systematic, it's like VIX up, delever, VIX up, delever, and I hate that, because there's no fundamental reason why things happen sometimes.
We used to talk about this a lot last year during that yen carry on line, but just the index of like implied correlations, it's just crazy to zoom out and look at this. Like we are in just this secular regime of just like really tight correlation, or sort of uncorrelated, where it's just like
low implied correlation.
Low implied correlation. And just, I think it just really ties into this idea of just how much market structure has shifted over the years. Like look at where we used to be versus now this new regime of like super, super low. It's just crazy to me.
This is so systematic. It's self-reflexive, right? So as like implied correlation goes down, stocks have lots of dispersion, and you see lots of weird shit is happening in single stocks where, you see massive squeezes like Open Door, or there's little pockets of the market. I like to call it, the frontiers that you can play in that are actually a little bit more, they use fundamental, I'd say, more actively traded than. So when you have low implied correlation, you can actually go out on those single stocks and have an advantage against the systematic investors. But when that implied correlation starts ticking up, there's less dispersion in the market and everything starts acting the same. And that's the worst. It's the worst. Just get the hell out, because you have, it's usually when you have bond vol, equity vol, implied correlations going up, that's the correlation of one trade. And it's happening more frequently, I think, because you have these events. And the only thing that keeps all of the vol like it lower is government intervention and forward guidance and fiscal and all this crap that Trump's doing. And that's, in the end, that's centralization, right? Like if you have that much power, there's no reason. Like today was really fascinating because there's lots of idiosyncratic things happening. Like IREN crushed earnings, right? It was up. This is a Bitcoin mining AI infrastructure play. And they were up like 25% to start. And all of their peers should be going up because like now there's like a lot of really big fundamental catalysts. Because the VIX goes up, all these stocks get smacked down together at the same time. There's really because everything's so systematically traded and there's no traders left. It's all program trading. So that's, I don't know, the microstructure of the market is so screwed. And what's hard is it's really hard to battle the systematic guys over a longer period of time once it starts trading, but you almost have to just get out and wait for it to reset and then scoop all the fundamental things that just got oversold. So
I think something interesting today that I'm looking at, and I think it's important to remember that like 1 day of correlations doesn't make a trend. And, especially on like month end right now, especially like before Labor Day weekend. But regardless, when I look at just the context of the macro right now, and then comparing that to the correlations today, where it's like gold looks like it's about to meaningfully break out to all-time highs. Long bond yields are going higher. US equities lower, dollar lower. That to me is painting a picture of one, capital outflows, but then also I think some concern for what's going on with just this Fed independence idea and potential policy error. I mean, that's my opinion. Like I'm in the camp that inflation is a much bigger risk than recession right now, and that the risks for the labor market are overstated. So when I look at this type of price action, if it's durable, we'll see what happens in a week, but it's just interesting to see that rotation today. Like that is very different, especially when we looked at like the implied correlation index. It's not just this correlation to one degrossing thing. It does seem like some fundamental rotations going on. Breakthroughs begin with semiconductors. With over $23 billion in assets under management, the VanEck Semiconductor ETF, ticker SMH, is not only the largest semiconductor ETF, but it has also outperformed the next largest semiconductor ETF. It is built on an intelligently designed and constrained index that includes the whole sector stack, from design to manufacturing. Historically, this unique construction and methodology have helped SMH outperform its closest ETF competitor. Check out the table below. Go to vaneck.com/SMHFelix to learn more. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research.
Yeah, there's definitely no rotations. I mean, there's a massive, was fascinating is like IWM's only down 40 bips right now. Maybe that could change to the end of the day, but the dollar's barely down, and it started down a lot more, which is kind of in the Dixie. So I don't know. It does feel more rotational than, I guess, anything we need to be really scared of. But September is always rocky, early September. So I don't know. I don't think now's the time to really take like home run risk. But we set yourself up for having some good swings later in September when things change.
All right, so I want to dig into, last week we talked a bit about what could happen if Fed Governor Cook got fired and some of the second order derivatives of that. And Quinn had a great spiel about how that can have some meaningful implications on the composition of the FOMC and renominating the regional Fed presidents next year. And a lot of that is starting to really happen. So we got Trump trying to attempt to fire Cook. I think they're actually having a judicial hearing on this morning right now to see whether they can appeal it or not. But the fact of the matter is that he tried to fire her. That's happening. And then pretty much right afterwards, we got this headline talking about how the Trump team is weighing options to extend influence to Fed banks. The Trump administration is reviewing options for exerting more influence over the Federal Reserve's 12 regional banks that would potentially extend its reach beyond personnel appointments in Washington, according to people familiar with the matter. So that's when I compare that to the correlations I'm seeing today, I'm just like, huh, like, and this is a chart I was playing around with yesterday that I just found really, really interesting, which is looking at 5-year inflation swaps compared to oil. And look, I'm probably making some sort of chart crime here because I didn't do a fancy regression analysis or whatever. But I think just the fact of the matter is that, that oil and inflation are pretty highly correlated. Like oil price is one of the biggest drivers of inflation. So if you see oil go higher, it makes sense for medium-term inflation, especially to go higher just because of how long it takes for oil to trickle down into the supply chain and eventually increase prices across the board. Obviously, like month over month headline inflation can go up right away on an oil price spike, but then there's like that second order effect. So what I see when I look at this chart is this is one of the few times where you see oil either, at the bottom of the range or going lower. And then you have 5-year inflation swaps starting to look like they're about to break out, or at the very least, they're grinding higher. And when I compare that to everything we just talked about around this idea of Fed independence, cutting rates in September, I think it's a mistake, but I think it's going to happen anyway, and because of political reasons that you described really well, Tyler. But yeah, I don't know, I'm kind of spooked. I don't know what you think of this.
If this was accompanied by bond volatility, I would really get spooked. But I think we could be in for a global peace dividend. Like everyone and their mom is calling for like an inflationary spike. And if you get Russia pumping oil, I think Goldman came out this week and said oil could go into the 50s. Like there's massive oversupply. And, that's just one component of inflation, obviously. But, yeah. And the housing market is clearly in trouble when Bill Pulte's like tweeting every 5 seconds about Lisa Cook. So those are, owner's equivalent rent and oil are two of the bigger components of inflation. It's really, you might see it in the inflation swaps, but nominal rates aren't doing anything crazy. So like,
I know,
maybe that's just the control. We're in this control era of real.
I think it's the lack of supply of long bonds. Like there's just a scarcity.
That's the thing, is that they're actually just controlling the yield curve and the Treasury supply so well that it's squeezing people out at shorts. You can't short the bond market. It's like rule number one is it's so freaking hard to short the bond market because you get squeezed out on political talk.
I know. I feel like like when I think back, it's just like, I don't know if I've really made money on bond shorts. Like ever.
Never.
Like, it's just such a painful trade.
It's such a painful trade. Like even like this is what's funny is now that Japan is actually in secular inflation now, and the Japanese 30-year yields at like 320. Like theoretically, it killed people. They called it the Widowmaker trade for a generation, and I bet people still are making money on the bond shorts just because it's so hard to anticipate. It's just a political trade. So I don't know. I do think like if you just held it for 20 years, you're clearly going to make money because the only way we get out of this mess is nominal growth and inflation. That's how you delever the economy. And everyone's slowly getting there. I think everyone realizes that's why gold's breaking out to the upside. Some stocks are now, that's how you have to be in something that grows faster than long-term inflation. And people are preparing that by now.
Isn't it funny that it feels like the crypto crowd and the more like online degenerate trader crowd caught on to that trend a lot earlier. And now you're seeing like all the TradFi guys like really start to talk about this, but it does feel like, I don't want to say the left curve, but like, the people that were just tuned in that have noticed this much earlier than the sophisticated TradFi people.
Well, I would actually argue like most of my interactions with like the smart, not the degen crypto people, but the generally smarter crypto crowd, they know the history of central banking in world history better than anybody in the TradFi. Like if you read TradFi notes, it really concentrates in the last like 30 years of economics. There's no historical undertones. The only one that used to do is that guy Zoltan Pozar, who would like talk about, oh, this is Brett Woods number two, or Mike Howell does it, but he's not necessarily like a Goldman Sachs type guy. He was a Solomon guy, but he's got his own little shop now. But I love that stuff. Like that really nails everything when you talk about it from a historical perspective, and it's just rare in the TradFi world.
All right, I want to go through a couple charts to just make my case for why I think the economy is about to rip and that cutting is a policy mistake. Even though, like, I'm not fighting against it. I don't think it's not going to happen. But yeah, so we got the core PCE today, and if you look at like 3-6 month annualized numbers, it looks like we're rounding out. And I think like you do have good points around owner's equivalent rent and oil being able to keep this somewhat muted. But in the same vein, you have one of the biggest disinflationary forces of the past few years has been goods and goods deflation. Like there's a couple months where it's outright deflationary, and you talk on tariffs to that. It'll lead to an uptick. Like there's a speech yesterday from Governor Waller who's talking a bit about this, that without the tariff situation, we'd probably be really close to 2% target right now. The second order impact of that doesn't really matter. It's clear they're going to look through this, but does it become consistently higher inflation or not? I'm still 50-50 on that. I think, yeah, I think owner's equivalent rent and oil could keep it somewhat muted. Like to really get a huge inflation spike, you need oil to really surge. And on the same vein with owner's equivalent rent, with the housing situation, like that is just looking weaker and weaker with every print. So I don't know. Maybe it's just we just chop around between 3 and 4%. Maybe that's where we end up.
Yeah, I mean, the draconian scenarios of like hyperinflation in an economy with AI, like think about all the productivity we have. I just don't see it surprising us like the 70s. I don't see that, especially with Trump largely hating war. Like he really hates, even Bill Maher said this. He's just like, Trump hates war. He hates war. He just wants the business deals. And I think that's somewhat disinflationary. It might be, I've been thinking about this philosophically a lot, but get this. So even if consumer goods go up because, we're tariffs, we have tariffs and everything like that. This was a fascinating thing. Consumer goods are higher prices. You looked at PC, I think wages were up like, was it 0.7% or something, which is annualized is like 5%. And this is just a philosophically fascinating thing is everyone is, when they talk about it on CNBC, it's like wages were up. Uh-oh. It's like, what? Like,
I know.
It makes me fucking, excuse my French, but like, it's like, oh, that means our margins are down. It's just like, you sound like such a pompous capital, you're the capital class idiot. It's like wages should be good for the economy rising. It's like, as long as inflation doesn't spike. And so theoretically, this is the movement from capital to labor. Obviously, that's what they're trying to do. They shut down on the immigration. Pricing power for labor is actually higher now, so labor is actually getting higher wages. And this is an interesting thing: is if our consumer goods are more expensive and our economy is less around just like spending money for consumer goods. Meanwhile, in China, I read this. They're actually trying to create like more a boom. I read this from this Trivium newsletter. They actually do a really good job of like distilling stuff, but they're trying to create like a more pro sports thing, like entertainment, and create like they need the consumers to spend in China because they largely save money over there and they put it in the bond market. And now they need them to spend. So they're trying to make it like more consumer led. So as we pull back on like the consumer and like do more pro labor, they're going more consumer on their side. And maybe it's just the natural evolution of what happens when you try to like essentially deglobalize or you have a different type of globalization is you push and pull on these different levers. And I just don't know if, it's a bad thing if wages go up 20% a year and the bond market implodes and everything causes worse problems. But if it goes up steadily and your wages are going up more than inflation, that should be a good thing for society. It keeps the social contract intact.
It's a crazy example of that. I don't know if you saw what happened in Canada a couple of weeks ago with Air Canada strike that happened. It's our biggest airline in Canada, and the flight attendants were about to go on strike because they want to be, it's still so insane to me, but flight attendants don't get paid until the cabin door is closed. So all the boarding and stuff, they
Yeah,
don't get paid for, which is just the most messed up thing ever. And so
crazy.
they got to a point of actually going on the picket line and striking. But there's this rule in Canada where basically the government can force back to work orders. And so Air Canada was just not playing ball because they knew that the Canadian government, the Carney government, would just, like if we stop our biggest airline in the nation, like
Yeah,
economic activity implodes, right? Like we just can't do it. So
yeah,
they're like, all right, fuck it. I'm not gonna entertain this strike because I know the government's gonna come in and intervene for me. So then the Canadian government comes and intervenes, puts in the back to work order, and then straight up the union and Air Canada flight attendants just said, no, like this is BS. We're not following this. Like you
oh
can't
wow,
undermine, yeah, the labor class. So they were just like, no, like we're not going back to work. And it was like it was going to be an illegal protest. So they decided to not go back to work. And then lo and behold, 2 days after, Air Canada completely folds and they give the flight attendants what they deserve, which is like to be paid for the actual work they're doing, not just a fraction of it. And it was just such a crazy example of, this big capital empire of Air Canada assumed that the government would have their back, and they did. They came in the next day after, like, literally the strike went at midnight, and by the morning, the Canadian government came in and said, "Go back to work." So they were right to assume that, but they weren't ready for the fact that the union was just like, "No," and it was just wild. And so here we are. We're like the labor class actually won there, and it was well deserved. Like we shouldn't have the government intervening in these dynamics.
isn't it such a fascinating point? Like where we're all at is, I actually was talking about this, with one of my friends. Is when it's so centralized that the government and Air Canada have to, they make the decisions legally, and then the labor class has. It's just wild to me because back in the day, what I was saying is like back in the day, if a small company was doing a bad thing in your neighborhood, you could go to the guy who like poisoned your food and punch him in the nose and say, hey, you suck. I hate you. And by the way, the entire town hates you too. And you better get this right. And now it's like everything is they're so powerful on the corporate class that like, even if they like gave you cancer, you can't sue them because there's a layer of like, people up there. You can't even go on strike. The government makes you go back to work. It's just, and where my head is at is like, you have to have smaller companies because they have to break it apart. You shouldn't have monopolies that can just control labor like that. It should be a natural, there should be a supply and demand, more free market stuff rather than class warfare. And we're really just in the class warfare, part of the world. It's terrible.
And that's the thing is like I agree with all of that and that it's warranted, but it's hard to have that happen without also being like a bullish on inflation. Like secularly speaking, like you don't have these things happen and also not get the inflation genie out of the bottle. Like we're not going back to that 2010 to 2020 era anymore, right? Like there is a lot of very significant flows heading towards higher inflation.
Which is, yeah, and then you get the vanguards of the world still telling you to own 70% bonds, and you're like, huh? I don't know.
Yeah.
Unless they're expecting a crisis, it seems kind of odd to do. But I belabored that point a couple weeks ago.
Yeah. 100%. All right, let's go into some of your other charts. What do you got for us? Using a similar philosophy to SMH, the VanEck Fabless Semiconductor ETF, ticker SMHX, goes even deeper, exclusively investing in fabless semiconductor innovators designing AI infrastructure behind the scenes. We're talking high bandwidth memory, power management chips, custom accelerators, and ultra-fast interconnects, the critical components that make large AI models run faster, smarter, and more efficiently. Go to vaneck.com/SMHX Felix to learn more. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research.
I thought this was a good one. 25. This is from Jamie Coots. And similar to like, I think Mike Howell has a lot of these, but total US liquidity versus US public debt. Liquidity appears insufficient versus fast growing US debt. And the ratio of net liquidity plus M2 relative to public debt. And he goes, global liquidity is best understood as a perpetual refinancing machine. Debt keeps expanding faster than economic output, which means liquidity must expand in parallel. Otherwise, the machine stalls. The solvency of governments, banks, and broader system depends on it. And like this is really, the Mike Howell uh, framework of all this stuff is, we're hitting a point where if they don't juice it, if the Fed expectations for cuts don't come to fruition or they don't come up with another fiscal infrastructure plan, you get an event, you get a banking crisis or whatever this is. So I just think in the end they will always err on keeping the credit markets with enough liquidity so you don't have some sort of they're going to err on that inflationary cycle rather than the deflationary cycle, and we're kind of in the danger zone. So this is why it's really important right now. Like you could argue like when credit spreads are this like this much down, like really close to the lows, that's usually the end of a cycle. So if you see that reverse really hard, that will be a sign that there's some sort of credit problem in the system. But right now it's kind of just putzing along the lows, and guys are refinancing. You're seeing a lot of short squeezes in really crappy companies that are probably unprofitable, largely because the credit markets are open for these guys. And I mean, you're seeing insane stuff really, like Open Door. There's like, I don't know if you follow Shorty B at all on Twitter. She just goes, it's like this is such a market structure thing, but I think what's happening is she'll just find single stocks that are largely shorted or their floats are choked and just create short squeezes everywhere. It's kind of wild watching, but yeah, that's just because the credit markets are financing crazier stuff.
Yeah, the liquidity situation, I think it's for sure. I wouldn't say it's like a red light right now. It's sort of orange, I would say, but
Yeah.
you're right, it's getting close. And I think something I've shown a few times on this show, but this is from the Fed, and you can go here every week, but the reserve demand elastic, this is the best way to look for that danger zone actually coming to fruition. And we don't need to get too wonkish here, but yeah, like as the bank reserve levels come down to where a certain level in the percentage of GDP is, you either need at the very least, the Fed to stop QT, and they basically have, right? Like it's like $5 billion a month or whatever treasuries, and then the rest is mortgage-backed securities. But the fact of the matter is, they are getting to that point where some sort of shift needs to happen quite soon. But it's not bad enough yet to see that pivot point, and you can see this in this chart where the last time this happened was in 2019 when we had the repo blow up, and that's where you saw these very negative values. So right now we're still chopping along, definitely at the bottom of the range, but nothing to really see that pivot yet. But I do think it's coming for sure. Like when you look at what's coming down the pike in the next couple months in terms of treasury issuance with reverse repo where it's at, this is going to change soon. And I think when that change happens, there's going to be a lot of good and bad takes associated with it, because what will happen is that the Fed will start to buy up securities to increase bank reserves proportionally to the growth of GDP, because they want, basically, as GDP grows, they want bank reserves to basically follow it higher. And over the last 4 years, we got way above that because of COVID and everything. And now it's been mostly normalized. I would say we're like basically normalized now. But now as GDP growth starts to continue, we're going to have to see those bank reserves increase. So they're going to start buying. But the big question at hand is what do they buy, right? Like it's very different if they buy bills versus if they buy bonds. If they buy bonds, that's QE. To buy bills, it's not taking duration out of the market. It helps funding liquidity for sure, but it's not quite as powerful as something like outright QE where you're just fully taking the duration out of the market. So
Yeah.
I don't know. A lot of moving parts.
I think but look what you're talking about. That's not a free market. It's you're keeping the Ponzi going. One of my buddies that I used to work with in the TradFi industry, we had a great exchange on text. And he says, what the government's really just doing is they're keeping, they're sacrificing the bond market and their currency to keep the equity market high. And I think who was that guy, Bob Elliott from Unlimited? He said something like, you don't take anyone serious who says Weimar market. I said Weimar 32-minute mark. Anyone who says Weimar in relation to this market is ridiculous, unserious thinker. And I kind
How
of
does
get
that
where
make you
he's
feel, Tyler?
I kind of get where he's coming from, and I don't know if that was a shot at me or not, but but at the same time, I don't think you can ignore how absurd the situation is, and there's like people aren't having children. You might say on the surface it's 3% inflation, but like people are getting chopped up here. This is like there's massive social unrest. Like below the surface, there's massive social unrest. And so like if you sit in like a capital class seat where you're just looking at stocks all day and you're completely disassociated from society, yeah, you know, you might not think it's the Weimar Republic, but like Mamdani is leading in the polls. Like this is this is how it's made. And I think if you're not actually at least entertaining that reality that that's what we're in. And like Lynn Alden, nothing stops this train. Like there's people, Mel Madison, he's been really good too. Um, talking about like this is just MMT, conservative MMT, where you're trying to basically push money out into growth industries one way or another and keep the lid on inflation. So
Yeah, it's a MMT with a little bit of socialism baked in. I don't know. Maybe we should talk about the whole government stake thing because I don't know. What's your read on it, Tyler? I'm
the
trying not to
government, which
don't
one?
get us in trouble.
They got government stake in
Yeah,
companies.
yeah.
Yeah, I don't know. They did it into the banks. Like they did it with Citigroup at the bottom. They did it with, the auto companies. They've done it before. I guess I would argue like if this is wartime finance, like our debts are so big, you have to do crazy stuff, right? I don't love it. I don't think this is, if it was a less bit pro business president and it was, I mean, Trump's crazy, don't get me wrong, but like, it sets a bad precedent. However, you could also have a really good outcome here if the government starts financing like things and actually gets a return from them. Like, could you imagine that? But I think historically, like during World War II, when you'd have public-private partnerships, that was one of the best parts of innovation used to happen. Like I think who was that guy? Vannevar Bush was like he created like radar, and there was lots of things during that time that they created which are omnipresent in our society now. So that could be the nice version of how it turns out. But I think if one of the charts we had, this is fantastic, is chart 27. I think if you look from the left's perspective, they think what's happening is like this is a takeover of society, and I guess you could. My argument to that would be I think you'd probably see the same thing from any Biden, like whatever, whoever, if Kamala Harris, it probably would have been somewhat similar. We're at the end game.
It's funny how biased people are about this. You posted this on Twitter. There's like a comment on it. It's like, oh, so it just means that Democrats are just upset for no reason, and you can see the bias happening because it's like, yeah, but like, look, there's many times where there's a Democrat president and Republicans feel like everything is bad. Like, come on, like check your bias at the door. Like, it's just
totally agree. I mean, but this is where the social contract is breaking. There's two different realities, and you have to understand that. And who's the hegemon? Like right now, Trump's the hegemon, reorganizing society. And this is probably too philosophical. I was talking to Michael Millerman. I take, philosophy classes on the side privately with him. And he's talking, he called it the Bukilization of society is Trump puts, troops on the ground in Washington, D.C. to really clean up. And it's a Platonic thing, like from Plato, where you have to have law and order in a society. And that's really what Trump seems to be doing, is like reinstilling law and order in places. And largely, like, I don't know, we'll see what history says about it. Like the left would say, this is fascist and this is horrible. But then I don't know, sometimes you go to some of the communities and they're like, well, this is kind of nice. We don't have to like worry about ourselves for the first time in a long time. So I don't know how to believe it. I can see both sides of it. And I just think that the Bukele model is actually winning. And that's, you can actually have economic growth if you have law and order in a society that's actually like not a free for all where you can just take other people's shit and not get in trouble. I think you have to have some sort of baseline of society like that. And most people are actually probably in favor of that, but I don't know. The polls don't seem to say that.
Yeah, I mean, maybe the Bitcoin maxis are wrong. I mean, maybe the libertarians, the ones that just believe like the sovereign individuals, maybe that idea is, a certain extent of that is good, but it's just interesting when you mention these ideas of these eras we've had between public and private partnerships that led to serious innovation, like the nuclear bomb and then like radar. And you can make the argument that semiconductors and AI is just going to be the next version of that now. And you compare those eras to eras without these, with fiscal gridlock, nothing happening. The only real innovation that we had was just algorithm doom scrolling in the past 20 years. It's just like the
Yeah.
social media doom slop and no
Yeah.
real innovation. So I don't know. Yeah, maybe the libertarians are wrong.
I agree with that. I think there's an old mentor of mine used to say, like, you go from, it's an evolution of like libertarian, and then you realize like, oh, you actually do need the government.
Yeah,
It sounds great, but like, for instance, like you wouldn't have a space economy. Like we're actually massively subsidizing. It's partly why like all the space stocks are going bonkers. Like Rocket Labs. I won't be able to say that in a week because I'm starting a new gig. But without the government really subsidizing, you wouldn't have SpaceX. You wouldn't have a lot of these new innovations. And I think that's the new formula. It's here to stay. Is you're gonna have like little technological innovation, and then the government will break open the doors. I think the solar industry is a good example of that as well.
And that's a good segue into, you had some charts in here about just the AI CapEx cycle, which is obviously a big theme of this. What's your thoughts there? Yeah.
Well, so I did a little Twitter thread. This is like, start with slide 32. You'll like this story. At 2008, I was at this firm, KBW, is a investment bank that studies banks, and they were one of the first ones to call the financial crisis. And then I realized like, oh my God, they're printing so much goddamn money. And I got a gig with this guy named Bob Haber, who started a firm in Boston. And it was primarily like a natural resources. He was the CEO of Fidelity Canada and started his own shop. And it was all natural resources and a lot of gold. He was super gold bull. He was like, listen, they're printing money till the cows come home. The debts are too big. And, we went, and this is the gold bull. During that time from like 2010, 2011, 2012, gold was absolutely ripping. And all the gold miners levered up, and they basically used the debt markets because money was so freely, borrow. You could borrow a lot of money, and you were financing all sorts of crazy, especially in Canada, crazy gold companies. They were just making up companies left and right. Oh, here's this resource. Probably how it was fraud and Chinese money laundering. But anyway, so you see these CapEx bubbles when there's a big narrative. And essentially what happened was, the gold price rolled over. Now you have these huge debts from all these miners, and they oversupply the market, and then the price goes down, and then a lot of them die or default on their debts, and it takes a while to delever. And you can see, from 2013 to 2024, basically these companies just help they reform their balance sheets and delevered a lot of the debt. And now the gold price, they didn't really dig up much gold, and now the supply and demand is completely flipped. Governments are buying gold now, and these companies are really, really healthy. And so this is exactly when you want to buy the gold miners. They're breaking out on strength. Oil's low, massive margins, like operating leverage is fantastic. And so anyway, this is my point getting into the AI cycle is we're actually, if you go to the next slide, so AI, they're saying last week, $400 billion in CapEx was supposed to happen in AI this year. And then NVIDIA reported, and now I think Jensen said it was like 600 billion up. And then it was going to go to 3 to 4 trillion by 2030, which is just wild numbers, first of all, even if he's in the ballpark. And so this, to do apples to apples. This is kind of like similar to, that gold boom in, from 2008 to 2012, where, okay, you have this self-reinforcing narrative. These companies are getting financed incredibly well. You can borrow money at really cheap rates. And then, there's probably a bunch of sociopaths that come and try and raise capital and tell a crazy story about how they're the next AI big thing. And anyway, that's what happens in a big capex cycle with this. But you have to pay attention to when it's stopped. Like, I'd actually think it's earlier innings until those credit spreads widen. I don't think this busts. And so go to the next chart. And Cuppy and Kevin Muir had a great.
I was going to ask if you saw Cuppy's article. That's great.
Well, yeah, he had a great. I didn't see the article, but he talks about this phenomenon. Yeah. But they're basically say it's 20 billion in revenues, and they have 400 billion in capex to service all this stuff. But this has to keep growing. If this does not keep growing, that debt becomes unsustainable. And the
amortization schedule of this AI capex is, I think he said something like 40 billion over 4 years or something.
Yeah. Okay.
So like the replacement cost of it is going to be like
a lot,
man.
So, and if you get into the geopolitics of it, the government really probably needs this to work. So
maybe they fund that amortization and replacement. Like, yeah, I mean, that makes sense to me.
I mean, there's a lot of things. There's a lot of things that's different about this one because you can't have China beat you to it. So financing costs maybe have to stay low, and this is like a ultra boom. Like this could be 1998. But you have to keep these in your mind and say this could be the third inning or this could be the ninth inning, right? Like you don't really know. And then here's where there's the next chart is where you could argue it's the ninth inning is. User registrations from AI search basically dropped off a cliff. And so that, if fundamentals, if revenues roll over from here, yikes, watch out. I don't know how, that's just one data point. But so my point on all this is that you have to watch that capex cycle where if you have the debt and it's massively, you can refinance at great rates and the credit spreads are low and it's awesome. And you got the narrative, like the equities go through the roof. So, and then my last point was in crypto, and we could probably go this is slide 36. In crypto, we saw during 2021, 2022, that big boom was really just, lending money and massive, you could say capex, from FTX and Genesis, and it was just massive leverage, 3 arrows, and then it busted. It took a couple of years to come back from, and it doesn't feel like to me yet that this is like there haven't even been new funds that have been created. I guess you have treasury companies. I would love to add on top of this the treasury companies and what they've raised in debt, et cetera. That would probably be a better chart for this. So, caveat it, but it just, I don't think I haven't seen the euphoria yet in crypto like you have in AI. And so that's, those are the things I'm battling here is, existentially. What do you think?
Fortunately, Blockworks has this fantastic. Have you looked at this yet?
No.
Our treasury company dashboard.
Are we plugging this?
Yeah, you have free access to this. This is a service that I haven't sent this to you, but we have wicked data on all this. So you can see check this out, just how much Ethereum has been bought in the last bit. It took MicroStrategy years to get to 3.4% of all Bitcoin. And just in literally 2 months, we've gone from 0.15% of Ethereum being owned in treasury companies to 2.68%.
Wow.
That is monumental.
Wow. Yeah. Is this what is this portal? Is this
this is a good segue.
Yeah.
Blockworks Research has excellent analytics and research. But this treasury company dashboard is free. we'll have a link to it in the show notes. Everybody go check this out. Nice little plug. The research
Actually,
team
pretty
couldn't be
good
happy
plug.
for me.
I didn't even know this was coming. So
There you go. There you go. I wasn't even planning to show this either, but this is just what natural advertising looks like. But no, there's some really good charts in here if you want to dig into it, and you can see like the recent purchases by company,
mhm.
and
Wow.
all that. So I don't know, like when I look at these and you look at some of the MNAVs right now, like in the Ethereum treasuries, like they're SBET and BMNR, so Tom Lee and Joseph Lubin's ones, like they are either at one, or BMNR is at a slight discount actually right now, 0.98. So that's where I'm just like, okay, well, what comes next? You know, like who's going to be that marginal buyer? Because they can't issue really unless they start to go for the converts. They're sort of tapped out at the moment. So then it's
Yeah.
like, okay, well, what comes next?
Yeah. Interesting. They can buy. They have a buyback though. I think BMNR.
They can
Right?
buybacks, yeah, but it's just like, how do they fund the buyback, right? Like, are they selling ETH? Do they take a loan? Do they
Dude,
issue debt to buy back the stock?
yeah. I guess this is my next question. Is so this is the last time I could probably talk about single stocks, but with credit spread so low for high yield, why don't they just issue some fixed rate debt and not, I don't know.
Well, you got to be a certain size to be able to like tap those sort of markets. Like these are tiny companies.
Wait,
Maybe the big ones like BMNR.
yeah, BMNR is a $7.75 billion company. I mean, like that's
I think they could, and I do expect, like, if I do think there's a couple that can tap those markets, but I
yeah,
don't think all of them can. And maybe that creates an opportunity where some of the bigger ones can acquire some of the struggling ones that are sitting below MNAV and can't actually issue debt. Maybe that's what
yeah,
happens. I don't know.
yeah. Oh baby, Cypher's finally moving. It's up 13% now. Let's go, baby.
Cool. Anyway,
Sorry.
all right. So yeah.
Good one for
Anyway,
me.
we can leave it there. But yeah, you're starting a new gig next week. That's exciting.
Yeah. I'm starting. Wait, I want to talk about one thing. Well, first off, yes, I'm starting with Carson Block at Muddy Waters. Kind of funny, I say I'm so bearish, I'm bullish, and Carson.
You go work for a short fund.
Yeah, Carson's activist short seller. But they have a metals and mining fund, which is pretty cool, and they're doing some really interesting things that are in the pipe, and I'm super excited. He's obviously like Nate Anderson and him were the best short sellers in the biz, and now Nate Anderson's gone. So Carson's the last man standing in this bull market. You got to be doing something right. I mean, it's pretty incredible. Like when you think about it, since 2008, I'm just pumping his tires. My new boss, he probably not be watching, but like to be up every year as an activist short seller is kind of incredible when they're diluting the currency like this. It's like it's nuts. And I short sellers get a bad rap, but I think they're actually more needed now than ever with the amount of fake companies there are and ridiculous shit that's happening in the markets. And I don't know with the market structure, there's going to be some interesting stuff. Hopefully we do with market structure and I think it's going to be great for the next generation. But there's one other thing I wanted to talk about, which is the Russell. So like, who's awesome is JC Peretz. Have you ever had him on? He's just like as a technician, great follow. It's go to slide 28. Yeah, so this was what we talked about. Like,
sorry. Okay, 28. There we go.
Yeah, this is the Russell percentage of members of new 52-week highs. Like, all the breadth in the market is actually getting better, and then you have this massive short in Russell futures. I bet this probably collapsed a little bit, but then if you look at the Russell, I mean, it almost looks like on a 5-year or like a 3 or 4 year chart, like a giant cup and handle. And I don't know, the breadth is getting better for a lot of these companies. I just think like that rotation is finally here. There was another chart I had in here which shows like the ratio of IWM to Qs and how it literally hit the exact same point as like 2000, 2001, where everything piled into the large caps. And then after 2001, the small caps just took off. I mean, we could be in that same environment, especially if the government is,
indiscriminate rate cuts are going to be great for this.
Yeah. The line I had is like, the left is super scared of this centralized, almost like a king, where he's centralizing everything. But like, I think he's actually, it's ironic because I think he's actually trying to decentralize a lot of the centralization problems and create, more wealth for labor. He's trying to create, like, if you can get money into the Russell 2000, that means, that's more distributed power structures. And I think that's really what they're trying to do. But so the US market isn't so systematically shitty. But we'll see if that's right. Fast forward, we'll talk about it in a couple of years.
There you go.
Yeah.
Sweet, man. All right. Well,
It's
yeah, have a good long weekend. Congrats on the new gig.
Appreciate it, man. Yeah, we'll still be doing forward guidance, hopefully, but might be
buttoned up a bit more.
Yeah. Can't talk any singles. No more single stocks. It's my final Rocket Labs cipher.
Get your Shilton.
Now short me.
Yeah, there you go.
All right.
Sweet, man. All right. Catch you later.